I think reading is a very important way of being grounded in common sense, being expert in your field, avoiding groupthink, getting away from the noise.
The very effect of them making money on a stock or on a tulip is that it buys up their intelligence. Just because you make money on something, you feel you're right. People stop thinking critically and they follow the herd, they follow the masses. Everybody wants to get rich.
Hello and welcome to Connected Investor from the Brunner Investment Trust. I'm Julian Bishop.
And I'm James Ashworth.
Now, we spend a lot of time talking about markets, companies, economics.
But some of the most useful insights come from reading about history, psychology, or technology.
That's right. So in this episode, we're going to do something slightly different. We're going to talk about what we've been reading and how it shapes the way we think about investing.
Perhaps we could even call this the Brunner Book Club. So maybe to start, Julian, maybe you'd like to talk a little bit about what you've been reading recently.
Okay, so a couple of really fun tomes. First of all, a book called Recession by an economist called Tyler Goodspeed, The Real Reasons Economies Shrink and What to Do About It. And then secondly, it's a book called, related obviously, about 1929 by Andrew Ross Sorkin.
Oh yeah, that's the recently published.
Pretty recent, yeah. The inside story of the greatest crash in Wall Street history. And it is not, I would say, a particularly great book, but it's a sort of good reminder of the euphoria that can precede stock market crashes and economic depressions. Now, interestingly, one of the conclusions of the book Recession is that there is no real way to predict a recession. There's no time that takes place before economic expansion comes to a halt, that there are no obvious, consistent or clear catalysts. There are a few patterns, I would say. There's a few examples like wars.
Okay.
Not good. Energy shocks.
Yeah.
Not good.
So exogenous factors, really.
Sometimes exogenous factors, but they can be fairly random, like a single bank failure creates a problem with a financial system. There's the example given actually in the run-up to, well, one of the causal factors in the Great Depression was locusts. So locust plagues, which literally decimated the agricultural crops in the Midwest.
I've not heard that before. That's an interesting theory.
That is an interesting theory. Apparently, I didn't know this either, a locust is merely a gregarious grasshopper.
Okay, very outgoing. Yeah,
very outgoing grasshopper, and they don't apparently exist really anymore in North America for some reason. Not quite sure why. But the interesting thing about all of this is how quickly optimism, euphoria can shift to pessimism, despair, and that's typically what induces a recession. Some interesting things about 1929. First of all, people see it as being the end of the Roaring Twenties. Now, that expression in itself, the Roaring Twenties, did not exist in the 1920s. This was something that was used in retrospect. So almost at the time, they didn't feel that it was euphoric.
Okay.
And I think that's an interesting idea. There are obviously some parallels with today. It was a time of optimism around new technologies.
Radio at that point, I guess, and automobiles.
Yeah, so at the time, those would have been two sort of dominant things driving stock markets, certainly. But there was also a lot of retail participation in markets. So it was beyond the remit of professional investors. There were lots of people punting without really understanding what they were doing, what dividends were, what companies were, what financials were, etc.
Yeah, with the famous story of, I think it was John Pierre Pont Morgan getting a stock trading tip from his shoe shine boy. And I guess that was, for him, the sign that maybe this had become a mass market phenomenon when, you know, the shoe shine boy is giving you stock tips.
Yeah, and I think at that point, I'm not sure it was JP Morgan, I think it was somebody else, but at that point they decided it was probably time to get their money out of the markets. So I suppose the interesting bit is that history rhymes. There's been these sort of repetitive manias throughout history that typically result at some point in a downturn. And that whilst the technology has changed, the times changed, the presidents changed, human emotion doesn't. So humans prone to greed, euphoria,
Absolutely.
then fear and panic on the other side of the of the coin, and these are obviously very innately human conditions.
Yeah.
So what are you reading? What's
it's
on your
interesting.
list?
It's not the first time you've mentioned you were reading 1929. So
Yeah.
actually, after you mentioned you were reading that, I went back and reread the sort of classic book about the Great Depression. So this is John Kenneth Galbraith's The Great Crash, 1929, originally written, I think, in the 50s and updated a few times since.
Okay.
Which is a really good discussion of some of the background factors to why you had such a big stock market boom, and really why the overhang afterwards and the Great Depression was quite so severe. And there are many things that are different today, right? So, Galbraith calls out the fact that there was no lender of last resort. So when one bank failed, it had a domino effect. Monetary policy was hamstrung by trying to ensure that America remained on the gold standard. So there wasn't the ability to flex interest rates that we would now see in a sort of macroeconomic time of stress. And equally, on the fiscal policy side, so to do with government spending and taxes, it was a tenet of faith that the balanced budget was sacrosanct. So as you went into this Great Depression, and as tax revenues began to decline, the government didn't step up. It didn't increase spending in a sort of what we now call Keynesian spending way. The government retrenched, and so you ended up with this vicious cycle of tight money, government that's not spending, withdrawing capital from the market, bank failures, continuing in a domino effect. So I think it's always useful to remember how bad 1929 was, but also how much has changed since in terms of how we run the economy. So I think that's interesting. And you made the point about how sudden these changes in mood are, how the narrative can shift really quickly. Another book I read from the same author, actually, I really like reading this. I always read it, every couple of years, which is a short history of financial euphoria by Galbraith, where he basically, it's a really short book. It's only about 100 pages. He goes through lots of past bubbles. He goes, the classic ones: Tulip Mania, South Sea Bubble, the John Law system in France, 1929. And he looks at common factors, and he explicitly calls out, at the end of the bubble, it always ends suddenly, and it's never really clear exactly what the catalyst has been. There will always be lots of investigations afterwards trying to work out just what it was that caused the crash. But he argues that's really not the important thing. The important thing is, effectively, everybody who could be a buyer has been bought into the market. There's no more buyers, and something, it doesn't really matter what, causes that change in belief, a change in sentiment, the change in narrative, and suddenly everyone rushes for the exit. I mean, to give you the quote, talking about the crash, this crash never comes gently. It's always accompanied by a desperate and largely unsuccessful effort to get out.
Right.
I think that's exactly how it feels. And as you go through a 1929 type crash, we say in financial markets, escalator up, elevator down. Stocks go up slowly, but when they fall precipitously. And I guess that's one thing that maybe that book covered, but certainly the Galbraith book also covers.
I mean, we mentioned, to me, the sort of human element of greed, fear, euphoria, panic. But I mean, you use the word there, narrative, which, posh word for story, I guess. And we are storytelling animals. And I think most of these financial euphorias begin with an element of truth.
Absolutely. There's always that nugget that really sets off the story. And maybe in the 1920s it was technological change. It was the invention of radio. It was the rollout of Ford motor vehicles very widely. There was a sense that actually technology was changing, and life was dramatically improving.
And then again, dot-com bubble, perhaps more recently with AI. Time will tell. But there's always that sort of nugget of truth to what is changing, a sense of unbridled optimism, and one that often ignores economic realities. And I always think as an investor, it's very important just to be aware of the basics of capitalism. So, for example, the need to generate cash, the laws of competition, etc. Even when there is demand going up, when something is growing, competition is incredibly effective at limiting your ability to create profits.
Yeah, and one thing that was very interesting in this book is how he basically talks up how people making money, the very effect of them making a money on a stock or on a tulip is that it buys up their intelligence, right? So in his vision, just because you make money on something, you feel you're right. You become heavily invested in this belief that you are special. You're making money.
Yeah.
It feels good to make money. You can now buy things that you previously couldn't. And no one wants to think critically, right? And nobody likes seeing their neighbor getting rich.
Yeah.
So everyone else follows as well. So you end up with this sort of, I guess, don't know whether it's a virtuous cycle or a vicious cycle where people stop thinking critically and they follow the herd, they follow the masses into the story, whether it's radio stocks or .com stocks in the late 90s. Everybody wants to get rich.
Yeah, and everyone participates. Everyone wants to get rich quick, which I think is I often think of the Brunner Investment Trust as a sort of get rich slowly type of not that slowly, but type of trust. So not about sort of get the polar opposite to get rich quick schemes.
Yes.
We're investing in companies that generate cash, grow gently, hopefully we think provide downside protection when markets are tough, very diverse set of risks. All these things are important, but most people don't have the luxury of time. A lot of young people in particular are in a hell of a hurry. If they hear about somebody who's made 20, 30% in the last month, they want in, they flood in, and this happens time and time again throughout human history. So it's all reducible to a certain extent to human fallibility.
Yeah. The power of compounding, I guess, here is really important. The one book that I did read that I haven't brought with me is Morgan Housel's book on the psychology of money. And he's a really good sort of popular finance writer.
Yeah.
And one chapter he is titled, so I think when he wrote the book, Warren Buffett was worth $85 billion.
Yeah.
But when he was 65, he was only worth $1.5 billion.
A mere one and a half.
A mere one and a half.
Yeah.
But so effectively, in percentage terms, almost all of his wealth came after he passed the age of 65, just because of the power of compounding.
Yeah.
If you're patient and you compound your capital, if you get rich slowly, that's an incredibly powerful force. But it does, as you say, it takes time.
So there's still hope for us, James. There's still hope for us.
There's still hope.
Excellent. So we've touched there on some of the human elements, and I think you've read another book which sort of develops this a bit further. So why don't you tell us about that? This
book goes even deeper into the physiology of humans, effectively, and trying to understand how gains and losses, profits and losses, affect humans at a sort of deep biological level. So the book's called The Hour Between Dog and Wolf, written by John Coates. So he was a Wall Street trader who, I guess, chucked it all in and became a Cambridge University neuroscientist. And he spends his time effectively understanding how people make decisions and how their hormones change depending on whether those decisions make profits or losses. And he spends a lot of time thinking about and examining how, when a trader is on a roll or in a bull market where people are making profits every day, every position they touch, they make money on, how this sort of virtuous circle changes them physiologically. It increases the amount of for men in particular, increases the amount of testosterone in their blood. It makes them more risk loving. They take more risk. In a bull market, that's absolutely sort of the right thing to do, right? When the market's going up, as you take more risk, you make more money. This feeds on itself as a virtuous circle. But he talks a lot about, well, this also goes to extreme. You see the similar things in the animal world, right? So if you imagine a rutting stag, when it beats an opponent, it gets a big shot of testosterone into its blood, which makes it more aggressive and makes it more likely to win the next battle against the next contender, which is great. But it goes to extremes, and eventually that animal takes too much risk and spends too much time in the open and is more likely to suffer basically a fatal injury. And he sort of draws the parallel to traders, who take more and more risk, and then at the top everything goes wrong and they they basically get wiped out.
Yeah.
And he also looks at the other side. So what happens when people are in a bear market and continuing to see losses day after day after day? What that does, and basically humans get a stress hormone increase in their blood, the cortisol, which basically hunkers your body down for sustained siege and to deal with ongoing sort of stress.
Yes.
But it impairs your ability to rationally assess risks.
Yes.
So, in a bear market, people don't think rationally. People see. I think the sort of analogy he draws is that people see like lions and tigers everywhere. Right? If you think back tens of thousands of years, when if you're a human on the plane, you wanted to make sure you didn't get eaten. You would be risk averse, and when you were getting stalked by a lion or a tiger or a bear, you were always just focused on avoiding that sort of disaster. Basically. And you see a little bit of that creeping into individuals when they trade and when they're on a losing streak as traders.
I mean, this is very pertinent at the moment. We were discussing earlier. So there is a momentum index, which is basically long a bunch of stocks that have already gone up, and then short, so
betting on the price.
Against stocks that have previously gone down. Yeah. So it's sort of a momentum long-short index. And at the moment, it's at its most extreme year-on-year gains on record. So effectively, everyone's buying what's gone up, but they're simultaneously selling everything that's gone down. And a lot of this is AI winners versus AI losers. And so your point there about seeing fears where they don't exist is true. Everyone is poring over every existing incumbent company, particularly digital ones, and saying, oh, they're going to be ruined by AI. And I think it's certainly worth thinking about whether there are false alarms amongst those stocks, because there might be some real bargains. You also mentioned the importance of compounding.
Yeah.
And I think always worth remembering about compounding that if you go 10% times 10% times 10% times 10%, you rapidly get quite a lot of money. But if you do 30%, 30%, 30%, you get a lot more. But anything followed by a zero equals zero.
Yeah, a minus 100% wipes you out, doesn't it?
Exactly. So think intelligently and critically about absolute risk as well as upside risk. Think about what can go wrong. Make sure that your investments are robust if what you hope for and what you expect doesn't pan out. And there are ways of doing that. There's balance sheet strength, measures of operational leverage, etc., which can protect you if things don't pan out as you hope. And typically in periods of bull markets, people tend to maybe forget about that. So I think there's some interesting lessons there. And on the whole physiology of sort of winning and losing, I think that's fascinating stuff. I think with fund managers, you can tell by looking in the office who's outperforming and underperforming. Like the people who are outperforming sort of walking around bolt upright, very, very confident, having a great time. And the underperformers, they're physically hunched, losing confidence in their own abilities, et cetera, et cetera. So no, that sounds like a fascinating read.
It's a really interesting book. I think I read it first about 10 years ago, and it's been on my reread list since. So I finally got around to it.
Good stuff. Slightly unsettling though. It sort of implies that markets are driven as much by chemistry and biology as logic. And I think that helps explain why extremes happen. Markets are not just financial systems, they're human systems as well. And as we've discussed, humans are fallible. Another point that emerges from that, you look at what's happening to markets, you think in theory that they're very clear, rational, logical, economic discounting machines. But there is also momentum, there's groupthink, there's herding, there's emotion.
Stories, narratives.
And things can carry on like that for a long time until, for whatever reason, they don't.
And there's, again, another quote from John Maynard Keynes. Maybe I'll try and get one into every podcast.
Maybe you should.
His quote that the market can stay irrational longer than you can stay solvent. I guess for many investors, that is a concern, right? You're seeing multiple years of a trend going against you. It's very hard to remain rational and stick with your beliefs when everyone else is telling you you're wrong.
Yeah, I mean, the film The Big Short, if we're going to, originally a book, but the film The Big Short is very good at that. The sort of pressure that the guys who are betting against the housing bubble were under whilst it was going wrong, and the self-doubt, hemorrhaging money. And
Investor redemptions as well. I think that's the Michael Lewis book, isn't it?
Exactly,
it's
and eventually, of course, got proven right.
Yeah.
Okay, so I believe you have another book as well to discuss.
I have got another book
about one of the wealthiest families in history. So tell us about that.
Yeah, so this is a little bit different. This is called Fortune's Children, the Fall of the House of Vanderbilt, written by the brilliantly named Arthur T. Vanderbilt II.
Good name.
So
that's up there with Jerome K. Jerome.
Yes, exactly. It's a brilliant name. It's a really interesting book. So Cornelius Vanderbilt when he died in about the 1870s, he was the richest man in the world. So he turned a $100 loan from his mum into a $100 million fortune empire. So he was phenomenally wealthy.
In 100 million in terms then?
In terms then. So, tens, maybe hundreds of billions in modern money. But the really remarkable thing, which is what this story covers, is what happened in the future. And within about 2 or 3 generations, all of that money was gone.
Wow. Somebody had a good time.
It's a remarkable amount of money to burn through in just, a few lifetimes effectively. And it's a reminder that maybe the skills and the attitude required to accumulate money is very different from the skills and attitude that's required to retain it over long periods of time.
Yep.
It's just a fascinating sort of study of history of what can go wrong, and it's interesting. Like lots of personal finance lessons, I guess, they're about living within your means and not trying to keep up with the Joneses. So lots of the money was spent effectively trying to buy their way into New York high society. They were seen as outsiders. Yeah. So they, threw fantastic parties, built enormous houses, built summer houses in the Hamptons. And then, there's obviously bits of misfortune. They built an enormous yacht. I think at the time it was probably the biggest, privately owned yacht. It was so big that when it sailed into the Dardanelles, that the Turkish Navy attacked it because they assumed it must be owned by a foreign state. So it couldn't possibly be owned by one individual. Yeah. So I think that was a really interesting lesson. And obviously, the Brunner Trust is an intergenerational wealth transfer vehicle. So we think a lot about long time horizons and ensuring wealth can be transferred over time. This is perhaps a textbook example of how not to do that.
Absolutely. I mean, so the Brunner Investment Trust, for those who don't know, it was founded by the Brunner family 1927, so almost 100 years ago. And the Brunner family still own just under 30%. So it's been used for that family to manage their wealth over a number of generations. So clearly the Brunners family fortunes has been better than the Vanderbilts.
Absolutely. I think that's an undeniable conclusion.
Excellent. Okay. So I suppose, thinking, or standing back a bit, why does reading matter? How should investors think about this?
Yeah, for me, reading is, firstly, it's a pleasure, right? If you get a really interesting book that's really engaging, that's a great way of passing some time.
I'm not sure how I'd describe that one about recessions.
I think you might need to work on your curation. Maybe we'll talk about that when we get back to the office. But it's obviously a really engaging topic. Finding a great book is a great diversion. I think where it's helpful for me is it helps you understand the patterns of history. As you talked about 1929, and I talked about the Galbraith sort of summary of financial crises, you recognize that many things are not unique. They repeat over time. I think actually in that book, Galbraith makes the point that there is no other field of human endeavor in which history counts for so little as in financial markets. Each generation comes along, they think they know better than anyone else. They've rediscovered the wheel. But reading books, particularly books about history, is a great way of reminding yourself that actually, lots of these things have been seen before. And
history rhymes.
It doesn't repeat, but it rhymes, to give the old adage. It's also a great way of looking at things, basically consulting with experts on a particular topic.
Yeah.
You see that particularly, there's some really good sort of books about technology out there, for example. We spend a lot of time thinking about technological disruption. Lots of the information we get given every day from the financial markets is very short term,
Of course,
or by individuals who are not necessarily technical experts. But many of the books that you can find are effectively years worth of study from an individual who is an expert in that field, and gives you an education that you really couldn't get anywhere else.
Exactly. It gives you context, doesn't it? A grounding in thoughtful reality.
It's it gives you sort of longer term frame of reference. And I think, I can't remember if it's a Winston Churchill quote, but I think he said something like, the further back in history you can look, the further forward you can see.
That's good.
I don't know if that actually works. My crystal ball always feels like it's a little bit cloudy, but I like the idea of that. You understand, how we got to this situation, what developments happened previously that got us to this point, helps you understand, well, actually, what is possible in the future.
And I mean, you say your crystal ball is cloudy, but the future is necessarily uncertain. And I think when you're constructing a portfolio, you need to acknowledge that and try and create a portfolio that prospers irrespective of what precisely the future holds. I think reading is a very important way of being grounded in common sense, being expert in your field, avoiding groupthink, getting away from the noise, for want of a better expression. So if we bring that back to today's market, there's always a dominant narrative, storytelling animals. It might be technology, it might be geopolitics, could be something else, and it can feel very, very compelling. But history suggests that those narratives can be fragile, they can be fake, they can be real. We know that sentiment can shift quickly. So I think at all times important to stay grounded.
Yeah, and I think recognizing that this too may pass is important, right? Go back to the sort of physiological sort of study of the human and how how your body changes when you're getting gains or losses. Whatever the state of the world is today, it probably isn't permanent. Things do change.
They do, absolutely. Markets, they're driven by people as well as numbers. People are emotional, they're not always rational. I think history gives you a perspective on that. Reading gives you a perspective on that. And anything that helps you think more clearly is valuable.
Yeah. And understanding people and understanding history is just as important as understanding markets.
Interlinked, I would say.
Absolutely.
Excellent. So thank you. We should keep comparing books. This has been very, very interesting. And thank you for watching and listening to Connected Investor. If you enjoyed this episode, do follow or subscribe. And if there's a book you're reading at the moment that you would like to recommend, please get in touch. Leave a message in the chat, and we would maybe even feature it in a future show. Thanks, and we'll see you next time.